Lift Events and Experiences, known for Canada's #1 cannabis conference and trade shows, is hosting a full slate of events in 2023 and expanding to the U.S., and you're invited. Lift welcomes everyone from legacy participants to multi-state operators to everyday folks who enjoy and respect the plant. Join us in lifting the cannabis community together January 12th through the 14th in Vancouver, then Toronto in June, and San Francisco in August. Visit liftevents.com for details. That's liftevents.com.
And those corporate lending shops could give you more if they have capital today. They could give you up to 150 to 180% of the value of your real estate. But what they would do in exchange is tie you up with a lot of corporate covenants. In most cases, they're going to want a board seat. Every major decision is going to go through them. And you're effectively getting a new controlling party in your company. And so there's a real cost to getting that extra capital. So understanding your structures, understanding how these companies look at it is very critical.
From the PodConx studios, high in the Rockies at the beautiful Beaver Creek Resort, it's the Raising Cannabis Capital Show.
Today on MJ Bulls, we're continuing the 5th annual Cannabis Investors Series sponsored by PodConx, the cannabis industry's exclusive network of cannabis podcasts that actually allows cannabis companies to advertise. Go to podconx.com to connect to more cannabis listeners. On today's show, we're joined by Travis Goad, the managing partner at Pelorus-Equity-Group. Travis, welcome to the show.
Thank you for having me. Happy to be here.
Well, I'm excited that you're here, and I'm really excited that we have a company that's lending money in this space. And I think having more companies lending money is an important step towards legalization. And you're not just dabbling in cannabis. You're all in. As a private commercial mortgage REIT, you've done over 70 deals and lent over $350 million. As I mentioned in previous years, most of our guests were cannabis VC firms. Travis, why now is not a good time to sell off a lot of equity to fund projects?
So we're the longest running commercial real estate focused lender in the cannabis sector. We closed our first deal in 2016, and we're structured as a commercial mortgage REIT. And that means all of our capital is fully discretionary. Myself and my partner, Dan, sit on the credit committee. And so you get a streamlined process dealing with us. We've actually closed over $500 million in transactions since inception. And today we have about $370 million in AUM. Just a slight nuance there.
Well, I think it's a big nuance, 350 to 500 million. I'm glad you let us know that. Yeah. I know now is not a good time to sell off equity, but maybe explain why.
Well, because right now valuations are low across the board. I mean, when you see what's happening in the cannabis sector, because so few investors can actually invest in cannabis, the liquidity just isn't there. So when you have S&P and broader markets selling off 20% in a year, it means that these less liquid markets have to sell off more. And so if you look at a lot of the cannabis names, they're down 40 to 60% year to date. And part of it is there are some challenges facing the industry in the U.S., specifically with 280E and specifically with just the delays in regulations rolling out in order for these companies to hit their numbers. But a lot of it is just disconnected from the underlying growth in the revenue and what these companies are producing versus their valuations today. And a lot of that has to do with the macro headwinds. So if you're borrowing today, and for us, you have to own your real estate assets. But if you own your real estate assets, we can lend you money against those and make it less dilutive for you and your investors.
Yeah, it makes sense. It makes sense. Sometimes cannabis companies are unhappy down the road when they realize how much equity they've given up. They would have been a lot cheaper to borrow the money. What are some things that borrowers should consider besides just interest rates?
A couple of big things. You need to make sure that the lender out there actually has capital to deploy. In this environment, there are lenders out there who have deployed capital in the past, but have been unable to access capital today. And so you want to make sure that they actually have dry powder to put to work and something that they could actually close and perform on your transactions. I like to say that for the longest time, because we've been doing it the longer than anybody else since 2016, my biggest competitor was a fake term sheet. So, there was a lot of people out there that would write term sheets and claim they have money and they couldn't perform. And so dealing with a reputable lender that does what they say that they're going to do and can perform is critical. 2, dealing with a lender that is specific in the space, that understands the challenges that cannabis companies face, understand the nuances and regulation shifts. And there's always going to be something over the term of your loan that's going to pop up that is probably unforeseen. And that's something that when somebody, all they do is cannabis and they focus on cannabis, they can understand those issues and help you address them and deal with kind of the growth trajectory of this space. 3, it's also understanding what are your covenant packages, what you have to adhere to on a go-forward basis. We lend against the value of the real estate. So we give typically a more conservative debt amount. So we'll lend between 60 and 75% of the value of that real estate. So the hard and soft costs that went into that. And because we're at a lower basis, we're able to offer effectively a very covenant-light loan to our sponsors that let them have flexibility to grow their business and expand into new markets. There are other lenders out there that have much more of a corporate lending model. And those corporate lending shops could give you more if they have capital today. They could give you up to 150 to 180% of the value of your real estate. But what they would do in exchange is tie you up with a lot of corporate covenants. In most cases, they're going to want a board seat. Every major decision is going to go through them. And you're effectively getting a new controlling party in your company. And so there's a real cost to getting that extra capital. So understanding your structures, understanding how these companies look at it is very critical.
Let's talk about investing for a minute. Investing in cannabis, we all know, is risky. What are some of the tools that you use to minimize your risk?
So we lend against hard assets. So if you're coming at it from an investor perspective, and how we look at the space is that there's a real asset that has real value because you can generate revenue and it's a highly specific build out. I would comp cannabis assets very closely to cold storage facilities, data centers, lab spaces, other types of specialty use real estate, but that have significant demand for that use. And so from an investor perspective, in a really early stage industry, which we're in the very first innings, they tend to be very volatile. We saw the first round in 2018 where equity valuations ballooned, but none of these companies could make any money. And then kind of that reset going into 2019, and you kind of see the progression of the industry. It's just very volatile and illiquid space, and there's not as much kind of capital available to it. So we just think a more conservative approach is the best way to do it. And if you want exposure to cannabis, we think our model is one of the best ways to do it. You're senior secured on a hard collateral asset that there's real demand and use for, and you're still getting mid-teens yields for that risk. And in some cases, we have warrants and some equity kickers as well on some of our loans. So you're in a senior secured position, making near equity-like yields, and you have some sweeteners to the upside. So it kind of insulates you a little bit about a lot of volatility you've seen in the equity space. And so even though equities have been all over the board over the last couple of years, up and down, our portfolio has been performing fantastic. We're still collecting monthly interest and paying our investors. So our investors did very well during that time frame.
I think I saw something that I read that your investors on average were receiving 15% since the time you've been doing this. Did I read that incorrectly?
No, that's correct. Not only 15%, but monthly distribution. So this isn't just an IRR that we solve for that is projected on kind of mark to market. Our borrowers pay interest every month. And as a mortgage REIT, we have to distribute the bulk of that interest to our investors. And so it's actually something you get a check every month. Now, a good portion of our investors choose to reinvest, which again is another ability to help compound that. So you're getting mid-teens yields that you can ultimately compound monthly under our structure. So it's been a very popular product. A lot of our investors reinvest. We think in this situation, showing cash returns is very critical for this industry.
Yeah, it's almost unheard of. It's almost unheard of. Before we wrap up, I know you operate in all the legal markets. Are there any markets that are particularly interesting to you right now, or maybe just different states that you're targeting?
So we think a lot of these markets are very interesting. Our goal as we grow is to have a diversified book. So we want some smaller operators as borrowers. We want some larger operators as borrowers. I'm sure you saw a week and a half ago, we closed the TerraSyn transaction, which was about a $46 million loan to a tier one MSO in their New Jersey and Maryland assets. So those were our first two properties in both New Jersey and Maryland. So we were very happy to kind of expand more into these East Coast markets. So we think each market has its own pros and cons as far as how it was legalized, demand structures, et cetera. So we price our loans accordingly and enter it. But there's not one market where we won't go in, or, I mean, there's markets we're definitely more cautious on, and there's markets that we think we're a little bit more bullish on as well, kind of given the construct. So we like New Jersey, we like Maryland, and we'll continue to look in the Northeast and Southeast markets as well.
That sounds great. I'm glad you mentioned that transaction. I had that in my notes. I wanted to make sure we touched on that before we wrapped up the TerraSyn transaction. We'll have links to Pelorus Equity Group in the show notes. So if you're looking for lending, or if you're an investor, just click the links in the show notes, and I'm sure somebody from Travis' team will be happy to speak with you. Travis, it's great getting to know you today. Thanks for being on the show.
Great getting to know you as well, and thanks for having me.
Thanks for listening to today's show. To check out more great cannabis podcasts, go to PodConx.com. Here's a preview of one of our other shows.
I'm Josh Kincaid, capital markets analyst and host of your cannabis business podcast, The Talking Hedge, and newest member on PodConx. So come on over and check out The Talking Hedge. We talk about business news, interviews, investments, events, all that stuff. So come nerd out with me over at The Talking Hedge. You can find me at thetalkinghedgepodcast.com or on all your favorite podcast platforms. Don't forget to like, share, and subscribe, or don't, and I'm out.